All right, y'all. I'm really excited about this presentation tonight, but I can't wait to just unveil this to you and just step into this new season for each and every one of us, not just me. So, the first question I want to ask is, what's the point of success if you're too busy to enjoy it? Let's redefine your freedom. I know that a lot of you are real estate investors, you do 1 or 4 units. And for those of you who have actually own, if you own a portfolio of 1 or 4 units, and you probably already know, like, this is not as passive as I thought it was. And it's just not as passive as I thought it was. So we're gonna talk about how to get true freedom. And I'll tell you guys a little bit about my story of my passive experience. So, welcome to tonight. Your presenters for the Invictus Elite Capital Group Fund is myself, Nicole Purvey, Arthur Lyons, and Noel Parnell. Um, thank y'all for being flexible with the time as well. Um, we're going to talk to you guys about how we ended up doing this, how this all came to be about, and how you can be involved. So, for those of you who don't know me, I'm Nicole Purvey. I am a real estate investor. Believe it or not, I used to work on Wall Street. I used to be an institutional bond trader. That is when I worked in corporate many years ago. That is what I did. That was my last job. I worked at Vanguard. I worked for um, a brokerage in Philadelphia called Janney Montgomery Scott. They actually hold the second oldest seat on the Philadelphia Stock Exchange. Well, I know when I worked there, that was a long time ago. I then worked at a company called West Capital Management, and then landed last at Toyota Financial Services, issuing commercial paper, medium-term notes, and doing currency swaps. I'm telling you all this because I never probably went through a lot of my resume details, but it'll give you a little bit of context for how we even got here. But starting in 2010 is when I forcibly decided to be an entrepreneur. I was actually fired because when you work in finance back then, you can't do anything else, especially not internet teachings and YouTube or anything like that. Like, the world has changed a lot since then. But y'all know me, I'm no matter what, whether when I'm high, low, I'm always going to be an educator. I don't know. I've been doing this since I was in, I don't know, elementary school. I was that kid that just let's do a tutoring session. I was the kid that, like, if it was easy, you could cheat off of me. Like, I'm not lying. Like, I've gotten in trouble many a times for letting kids cheat off of me. I don't know, something about my personality that's how I am. But I was learning all this stuff on Wall Street, and I was like, oh, I'm gonna do a YouTube channel. I mean, literally, YouTube was probably a year too old at the time. And my company found out, and it was like, nah, you can't do it. And then I was like, I'm gonna keep doing it. And then it was like, nah, you can't do it. And I was like, I'm gonna keep doing it. And they were like, okay, you're fired. And then I got fired, and I never dusted off my resume. I was like, all right, well, I'm just going to do this entrepreneurship thing. I think my body was just like kind of rejecting the job thing. And then I never looked back. And that's me and my little guy. We live here in Southern California. So let me tell you a little story. Some years ago, 2016, 2017, I decided I wanted to start investing in real estate. And at the same time, a bunch of people decided they wanted to start and learn with me as well. And so in that first year, I put on my first large conference. Actually, this was my second large conference, called the Women in Real Estate Summit. And I'm going to play this little video just so you can get some context. Oh, it won't let me play it. Oh, no. I had a little video, but it's not letting me play it because of my computer issues. Nope, sorry. And so that was our first event, and it was the coolest thing in the whole entire world. I had never imagined that we would be doing anything like that. And we had a ton of people there. And I want you to keep these pictures in the back of your mind. So this was in 2017. At that event, the Women in Real Estate Summit, there's Art on the left. Keep him in mind. We gave him an award for being like, I don't know, the best member, because he was always super helpful, and he was starting out his real estate career at the time as well. And we was all just like really getting busy real fast. In the middle was Jabbar. Y'all know Jabbar been in real estate for 20 plus years. He got an award that day as well. And then I just so happened to find this picture on the far right. That woman is my mother, and Noel is behind her. I didn't even realize that Noel was actually at that event. And that when I stumbled across this picture today, it warms my heart. So I'm just showing you this to show you that we've been doing this together as a family for a very long time, and we've all literally watched each other grow up. And this is my family. I would do anything for these guys, and I'm just so very proud of where they have come, how far they have come. So keep all this in mind. We're gonna come back to this in a minute. And I left the dates up there. If you can see, I'm not lying. It's 2017. Okay, October 28th, 2017. So I continue to do large events and actually build up a portfolio. This is one of the latter Women in Real Estate Summits. You see people are there, it's packed out, we're having a good old time. And then I ended up building a portfolio myself. So here's some pictures of the properties in my portfolio. And so it was great. And then I had an epiphany, a whole entire epiphany. It was a hard epiphany, but I had an epiphany. And that's me typing, and then the idea comes to my mind. And my epiphany is I don't like being a small landlord, specifically a small landlord. It's not my favorite thing to do after all these years. And I want to emphasize the word my favorite thing to do. My favorite thing. I hate dealing with tenants. I don't like dealing with contractors regularly. For those of you who have ever worked with a contractor, y'all know that it's just not my cup of tea. The margins have gotten slim between vacancies and repairs. Like you can get one repair, and it can, if you are a small landlord, let me emphasize that. If you're a small landlord, one repair can wipe out your profits for an entire year or two. The market conditions have been very volatile. I have some stories that I could tell you about myself, and some of my colleagues, and my agent just told me a crazy story about property values. I don't want to scare you and make you cry, but and at the end of the day, one thing I pride myself on being is very self-aware, and being a full-time small landlord, I'm being really specific with my language here. Being a full-time small landlord is not for my personality, but I would still do it all over again, because this is a saying that I have said in BTS a lot. It's better than having a job for me. For me, I am like a bull in a china shop at any type of job. And so every day I'm just thankful that I don't have a job. And being a landlord, if I got to deal with all those things that I said before, being a landlord, I would choose that all day, every day over having a job. Okay. So I'm eternally grateful. Also, but more importantly, the experience. I gained a lot of experience. What we're going to share today, I don't think I would have enough courage to be able to do if I hadn't bought those properties. And so I'm eternally grateful for that. So I would do it all over again. I do not recommend anyone not doing it. But there are easier ways. And so let's come back to this picture of these guys. Jabbar Art, he later, we all came up together, right? So Art ended up doing wholesaling and buying some investor properties, but then he decided that he wanted to go on and invest in multifamilies. To be honest with you, back in 2017, Art was trying to get me to do multifamilies back then, and my head was just not there. You're gonna see a picture from that in a minute. And then Jabbar has always been trying to get me to do bigger deals, but my head wasn't there. I couldn't see it. It's like so bizarre how you just can't, sometimes you just can't see something. And been trying to get me to come in the game for a very long time too, and I just could not see it. And also too, I want to highlight these are the people that are in the fun with us. So it's Jabbar, Art, Noel, and then also my dad. So as you can see, my mom, there's another picture of my mom. She hates when I post this picture of her in the middle because her hair, she said her hair looks crazy. But that's me down at the bottom, and then my dad, and then my dad on the right. And I'll give you a little bit of context around how integral he is as well in this. But the five of us decided that we were going to really work together to make this fund come alive. So the idea all started, it all came together for me, I should say. It came together for me a little over a month ago. I went to Philly to do an event, and then of course I'm gonna link up with my family. So Art and I, dang, it was a picture right in the middle of me and Art. It was actually a video of me and Art. We decided that we were going to go on a 3 mile walk on Kelly Drive if you're in Philly, and then we went up to the Rocky Steps, and the video is magically gone. We took a video in front of the Rocky Steps, and then we walked maybe another mile to this little brunch spot where Noah was like, "Oh, I'm gonna come meet y'all." He did his workout. I don't want to discredit him. We did our little 3 mile walk, but he did some, I'm sure, some intense stuff. And then we went and had brunch. And earlier that, maybe the day before, I had a dinner with Jabbar. That's him on the right. And at this, I don't know what it was. I wish I could tell y'all, but it all clicked for me because I had been feeling how I was feeling about doing being a small landlord. And I think just echoing in the back of my mind, the fund idea that that Art had, and the things that Noel been trying to show me, I was like, hey, we should all do a fund together. Specifically, like I literally had the people in my mind already. Specifically, Noel, Art, Jabbar, my dad, and me. That's exactly how I want to do this. And so that was literally the birth of it. I ran about Jabbar first. He said, yeah, absolutely. Jabbar do anything that I say. Then I ran about Art, and I was like, you think Noel will say yes? He's like, he's absolutely going to say yes. And so that's how it all went down. But I want to be really clear about the synergy here. It was not about, hey, let me just pull 5 random people together, because I think that's where me and Art talked about this. That was where we went wrong. I think I have the picture on the next slide. Bear with me. Oh, here's the video of me and Art at the Rocky Steps, but I can't play it for whatever reason. Womp womp. Okay. Anyways, this picture here was the group of people that we were trying to do the fund with before. Some of these people that are in this picture I love to death. But if you see Jabbar, Art, and I, and this is all the way back in 2017, Jabbar, Art, and I just so happened to be sitting together. And we were trying to get a fund popping then. And so I say all this to say that I think the thing that we did wrong and why it didn't come together, outside of the fact that my eyes hadn't been open yet, was just us just saying, hey, let's just pull all our favorite people together that just so happen to love real estate. And that's great. And I'm only saying this for those of you who are thinking about partnering. I don't think you should partner. I think you should invest with us. Don't do it, come invest with us. But if you are thinking about partnering, definitely do it with people that you love and trust, or more importantly, do it with people that you trust, right? But over top of all of that, do it with people who fit specific roles. Okay, we're going to talk about the roles in just a minute. And that was the thing that made this a lot different this time. Everyone had a specific role that fit into the fund. Okay, so if I'm not a fan of doing small deals, why large commercial apartment buildings? One, economies of scale. Larger properties allow you to spread costs like maintenance, management, utilities across multiple units, maximizing profitability. Remember, I talked about how one repair can wipe out your profits for a property for a whole year, or a vacancy that's set for a couple months can wipe out your property for like a couple years, wipe out your profits for your property like a couple years. But when you have large apartment buildings, obviously that risk is spread out. And so it increases your profits, right? If you have one vacancy in a large apartment building, that's not going to affect you the way that you have one vacancy in a duplex. Okay. Consistent cash flow. Multiple units reduce the risk of vacancy impacting income, providing reliable and predictable cash flow. Easier financing. Lenders often view large commercial properties as less risky due to their steady income potential, offering better financing options. Hello. Professional management. Larger buildings justify hiring professional property management, freeing up your time while ensuring expert oversight. This was the thing that really kind of clicked for me, because I was doing a combination of self-management and hiring people. And it's like, I need somebody to do this full time. And there is a big gap between your first property and when you have enough properties to hire someone to do this full time, and that you can like pay a salary, have them on payroll, and like do everything right and be paying them competitively, and have them dedicate all their time and energy to you. There's a big difference between that first property and then that nth property where you'll feel comfortable doing it. The next thing is professional or forced appreciation. Strategic improvements like upgrades or rent increases can significantly increase the property's value, creating wealth faster than smaller investments. So smaller investments, the value is based on market conditions, comps, whereas with multifamilies, the value is going to be based on the income. And so like we're seeing right now in some parts of Philadelphia, if you're investing in Philadelphia, like we're seeing, everyone, can you unmute yourselves? I can't mute. I don't feel like explaining it, but can y'all just mute yourselves? So, anyways, um, as we're seeing right now in Philadelphia, where the comps based on total supply and demand and interest rates and some other underlying things, it affects your property value. Whereas with large apartment buildings, it's based on the income, period, point blank. That's it. Not what, like, oh, somebody decided they want to sell a property for cheap down the street and now that affects your property value. No, that stresses me out. And then for me, this is utmost importance, teamwork. Everyone can focus on their strengths and passions. So there are parts of investing that I actually do like, which we'll talk about in a minute. And there are parts that I don't like. And the parts that I don't like are the parts that Noel and Art love. And I love that for us. And so this allows me to work with the people that I care about, the people that I trust, while they do the part that I don't want to do, and I do the part that they don't want to do. Okay, so the birth of the Invictus Elite Fund, that's the name of our fund. It's called Invictus Elite. Here are the four main components of putting together a fund, and this is where it all kind of came together for me. Like, remember That's So Raven, how she would have those visions from the future, and it would be like looking down a tunnel, and it would come real fast. That was the experience that I had when we went to brunch that day, or earlier that day, actually the day before, was I just, based on my experience in finance, I know how all of this works, right? Like I traded bonds corporate, institutional. So what does that mean? That means that the smallest trade I did was $100,000. And if you came to me with $100,000 trade, one, I was going to rape you on the rate, because that's such a small trade. And we were doing $200 million trades like it was nothing. The largest trade that was ever done on that desk that I worked on at the time of me leaving was done by me, and it was for $1 billion, a trade with Fidelity for $1 billion. So I'm just giving you some context as to why I understood what all the components that went into it. So you're going to need someone to handle investor relations. You need an investor specialist. This person is like the math nerd, the asset expert, the risk manager. Then you need to have someone to find good deals, and you need to have someone to basically do the administrative portion, which is the fund management itself. Okay. And so once I really just sat back and thought about it, I'm like, oh, we got all the people, we got all the pieces. This doesn't make sense for us to be operating in silos like this. And so this was the birth of Invictus Elite Capital Group. A couple weeks ago, some of you have seen online, a couple weeks ago, we all got together and everyone flew out to my place here in Southern California, and we nailed down all the details. And so at the end, just so happened that one of my homegirls was there. She took a picture of us, and this is us plus some other family members and loved ones. And so this is the birth of Invictus Elite Capital Group. So far I talked about how and why we wanted to create Invictus Elite for ourselves. But I want to talk about why we built this fund to benefit you. So there is a very famous book called Good to Great. Let me know in the chat if you've ever read Good to Great. Say it, type in the chat, Good to Great, if you've ever read in the chat, read it in the chat. Let me know. No, good. Quite a while ago. Okay. Let me know, yes or no, everybody. Tap in. If you don't comment, I know all your names. I'm just going to assume you don't read at all and you're illiterate. No, not reading it is different than I'm illiterate. Thank you, guys. All right, everybody else, continue to tap in, please. All right, so in the book, so let me give you some context since there's a lot of news. The book was written by, I don't know why, I can't remember the guy's name, but it's basically a really, really smart guy. What he did was over the course of 10 years, he put together this think tank. And I don't even know where he got this funding from. I'm sure you can find it on the internet. But for 10 years, they worked and pulled together all this data about companies over the past, I think like the previous 100 years that, and their goal was to try to figure out the difference between the good companies and the great companies. And they had very scientific ways to define what a good company was and what a great company was. And out of like maybe I think like 100 companies, only some low number, like 9 were great. And they defined it by like the way that the profits over time, the leadership, the this, the that, and it was a great criteria for it. They combed over obviously some of the hard numbers, but they also combed over interviews and writings and everything to really pull together all the data for this. They studied this for 10 years. It was like 20 to 40 people on this team. Okay. Crazy, right? And so one of the concepts that they talk about that defined the great companies was this concept called the hedgehog concept. And the great companies, they always operated in the intersection between what you are deeply passionate about, what you can be the best in the world at, and what drives your economic income. And so far, I've talked about what we are deeply passionate about, what drives our economic income. But as it pertains to you, we're going to talk about what we can be the best in the world at, because what we can be the best in the world at impacts you. And this is how we can serve you to help you get to your goals, whatever it may be. Okay. So we're going to talk about what we can be the best in the world at. And for us, we have a very unique skill set. For those of you who are BTS members, right? Obviously, all of us met through Better Than Success. You all know that we are a very unique community. There's nothing in the world like it. And as our position within the real estate world, we've been able to really cultivate a network and position ourselves and like really learn extremely quickly, which is why you see so many successful people come out of BTS. Our unique skill set positions us to provide better than average returns to our investors, minimize risk due to our competitive advantage in the marketplace, deploy capital very quickly. You're going to see that in a minute. Help you earn more passively, help you enjoy success. You've been too busy to enjoy it, right? Remember, we talked about that in the beginning, and redefining your freedom. And our fund is structured to minimize risk while targeting returns of 10 to 20% IRR truly passively for you, right? Again, some of y'all got in this game of real estate. They I'm gonna earn some passive income, but then next thing you know, you standing over top of somebody's toilet at midnight with a plunger, and you're like, "How did I get here? I'm tired," right? And so, what I want to talk about, what I want to do is pass this off to Noel. He's going to introduce himself and he's going to talk about the track record so we can show you how our team has been able to pull this off in the past.
Thank you, Nicole. For everyone, again, my name is Noel Parnell. I'm a real estate developer and one of the fund managers. I'm really known for creating lifetime cash flow through apartment investing. For really over the last 15 years, I've helped friends, professionals, former colleagues create passive income, tax savings, and increase their net worths. I have the privilege now to partner with Arthur and Nicole, and I wanted to kind of discuss some of the things that I have been going through really since 2017. Right now, currently there is over 135 million assets under management right now through investors that have invested with me. We have purchased properties throughout the Sunbelt area, including Texas, Florida, Kentucky, Georgia, and also have made great returns on the investors' returns. Not many can say that right now. So we will, one of the things I really want to key on that I think makes our fund different, and Nicole kind of touched on this earlier, was that we actually get to specialize in what we love most, you're happy that we're doing this. And so I wanted to speak a little bit about the properties and, some of the investors that we've had, since over the past, I think, was it 2017 and 18, had over $7 million in private money invested. And with that, 14% of their money, they've been earning 14% on their money. And that really just demonstrates, one, the performance and the reliability, not only of the properties, but also the underwriting. The underwriting is really, really, really key into selecting the right property. And to me, because I'm biased and I love underwriting, I think that's what keeps it's the transmission. It keeps everything going. It's the transmission. And because we have such a sophisticated underwriting, I guess, software, and how, in detail we get to make sure that we are getting the best possible returns for our investors, it's a proven strategy. And so to date, I think we've returned over 7 million, but we've returned, as far as return revenue, a little over $1 million. So they got their original capital back, plus they have earned over $1 million over this time frame. And that is so important. A lot of my investors that I had previously invested within, stock market. They have, positions where they were with Vanguard. But I would like to say, the average stock market return over the last 15 years was about 7%. But after your fees, inflation, taxes, and not to mention nosedives, the return probably went down to like 2.5%. On the other hand, multifamily, has routinely, like these type of apartments have routinely returned between 10 to 15%. And that's compounded without volatility and after fees and even inflation. That just shows you the power, of this fund that we have here. Where are we at? I got it. So let me just dive into that. So again, why settle? You might be asking yourself, why should you settle when you can have, exceptional? And you heard me speak about the returns from the stock market. Wall Street promises 10% on a good day. Mutual funds, maybe 8%. We delivered on 14% every year since 2017. That $7 million right now is growing to $11.86 million over that course. That's $4.8 million in pure profit, outpacing the SP 500 and mutual funds. So this is not just promises. This is proven performance that you can count on. All right. Yep. And we have, oh, that's Art. We have over here, so deals we're considering, some active deals. Art.
Yeah, you could go to the next slide, Nicole. So my name's Arthur Lyons. For those who don't know, I've been a BTS member from day one. I was investing in real estate, prior to that, but alone, and so hitting speed bumps by myself, not having a team. And the one thing that my single family career didn't really take off until I joined BTS and was part of a team, part of being able to have different people handle different things, being able to know who the go-to contractors were, and just having fun, just having like-minded conversations and things of that nature. So I initially started in wholesaling, which I think also I would not skip starting where I did, because starting in wholesaling helped me to really fine tune how to find good deals, essentially doing acquisitions and apartments, and the team atmosphere and being able to focus on the acquisitions part is something I love. And I'm excited about this fund, um, because doing this with BTS and BTS family and extended family, um, is just an amazing opportunity that we can invest together. Um, the Our mission is to strategically acquire and reposition multifamily properties in very targeted U.S. cities. And we aim for better than average returns, like Noel mentioned, than what the stock market can provide, and definitely better than what savings accounts, CDs, bonds, and things of that nature. Um, it's abysmal, the rate of return. You're really losing money if you're keeping money in the bank with inflation. Our investment focus specifically, again, is value add and opportunistic, which I'll go in a little bit more on the next couple slides. Just like with sourcing for single family deals, apartment deals, which sometimes seem to have a surmountable barrier to entry, which is not really the case. I use my skill set from the wholesaling and from single family and apply that to apartments. So we're still looking for value add. At the end of the day, we're still looking for distressed situations. Either the property itself can be distressed, maybe it needs some exterior renovations, maybe it needs parking lot resurfacing, maybe it needs renovations inside of the unit, so it's in physical distress. Maybe the mechanicals are getting old, and this is how you find properties that are at a discount. But people sometimes forget that apartment complexes also fall into other types of distress where the seller themselves are in distress. The same type of situations that happen in single family happen in apartment buildings, whether it's divorce. A deal right now I'm looking at, the wife and husband owned the property. The husband passed away. The wife really didn't want anything to do with the property, did not know how to manage it. There's death, there's probate, there's all of the same factors that we look for in single family. I've been able to apply to the multifamily world. So I'm not relying just on deals that are focused, that are on market. We're focusing on off market deals, pocket listing deals, and deals that are direct to the source. So value add is anything that we can transform, either adding value by renovating the property or correcting deferred maintenance, decreasing expenses, properties that may be below market rents, and things of that nature. So we look at hundreds of deals before we pick the diamond in the rough. And I like that example because, to find a diamond, you have to dig through rocks and stone and dirt, and you might pull up a nugget that looks horrible, but you clean that thing off and you find yourself a diamond. And it's not easy. It takes time and effort, but that's one of the benefits of investing in the fund is we do all that hard work and leg and heavy lifting, and then we as a team capitalize upon that. The opportunistic by definition is to capture substantial appreciation through development or redevelopment, acquiring distressed assets, um, major redevelopment properties. In our case, initially, we're focusing on acquiring distressed assets, like I mentioned before, whether they're physically distressed or whether it's the seller that's distressed, and also assets that are in emerging markets. It's very, very critical to know what markets that we are investing in so that we can provide great returns for our investors. Just because you live in a particular area, and there may be people on this call from all over, Los Angeles, which is a very expensive area, Philadelphia, which in my opinion has become more difficult to invest in and get these type of returns. Um, the good thing about technology and teams is that and cheap flights with Spirit and uh, all kinds of things is that you can get to these properties in areas that actually are valuable to our investors. So some of the cities that we've decided to invest in that have these um, opportunistic and value add are in our target cities are Houston, Texas, and surrounding suburbs, Alabama. Birmingham is really booming right now. Some of the appreciation there we've seen over the last year and a half, properties have doubled and tripled in value. Um, Tennessee, Knoxville, Chattanooga, Atlanta suburbs. Um, and from time to time, we come across deals that might be in secondary markets, um, such as um, we're delving into Baton Rouge, Shreveport, Jackson, Mississippi, Oklahoma, Oklahoma City. These areas are areas that have friendly landlord tenant laws. We also look in areas where our DSCR is going to be strong, which Noel may get into that a little bit later, but basically where your income or your rental income more than covers what your debt service on that property would be. In single family, you would think about it as your rent to mortgage, that ratio. And so these cities are emerging cities that have all of those positive qualities plus more. And that's why we've done significant and immense research in these areas to choose these areas. A couple examples of some deals that we have hot on the presses right now. Um, so I'm giving you a little bit of information about them. This property here is in Alabama. This particular one is about 56 units. We're in negotiations now. It's $3.6 million. Our game plan on this one um, has a hold time of about 3 years, 3 to 4 years, where we could either refi or sell. Our investors that invest in this would look at around 16 IRR, the internal rate of return. And the easy way to kind of sum it up is your total return on the life of your investment. And this property is poised to um, add value like you cannot do in single family. The exit value of this property is conservatively estimated at $6.9 million when the purchase price is 3.6. So just about double. And that is a very realistic thing that you can do through our detailed underwriting with apartment complexes. Even a small increase in the rents of 25, 50, 75, $100 over 1 to 3 years and managing expenses because apartments aren't appraised like single family houses, it's based on the net operating income. We can force appreciate um, properties like this inside of our fund to give our investors good return. And these are active deals we're looking at now. So, time will be of the essence to to fill the fund and get in on these. The next one is actually a larger property in Houston. This one also, and again, these are diamonds in the rough. These three are after looking at 125 deals, maybe. Would you say no? 125, 130 deals to find these three diamonds in the rough. So this one acquisition is 7 million. This one's actually a larger property, over 200 doors. Hold time on this one is also about 3 to 4 years. This one, 20% rate of return. Again, the situation that we look for specifically, and you'll see commonalities amongst these three properties because we look for these specific commonalities, is value add through renovations, increasing rents, prudent property management, and this property, it would be valued at around 13.8 million in that time frame.
I want to
This
also
next
just
property,
hold on real quick,
mhm.
Art. I do want to stress because Art said that they looked at about 125 to 130 units. For those of you who invest in single families, it's not apples and apples, right? Like analyzing an apartment building is so much more involved than analyzing a 4 unit. And so, I just want to just drive that point home that it's, for those of us who invest in 1 or 4 units, we can look at 130 deals easily, but looking at 130 deals, first of all, finding 130 apartment buildings and then the time it takes to analyze them is no joke.
Yes, that is a very good point. The spreadsheets that we use have about 13 tabs on them. We're combing through expenses and documents and line items of 85 line items of revenues and of expenses, and fine tuning, going through all of that with the fine tune code, market analysis, capital expenditures, the time it takes to really analyze these deals, and the time that we put on them as a team, and it's not an individual, um, is immense. And then just another example, uh, kind of in a secondary market. This one is in Mississippi. 1.7 million. Again, you're going to see commonalities because this is what we look for: value add through renovations, exterior upgrades, facade and parking lot. This one, the rents are very low because it's poorly mismanaged by an elderly owner who has not been managing this property appropriately. And so our job is to come in and reposition these properties. So those are a couple of the three hot deals that are actually on the docket now that would be inside of our fund to offer those type of returns. So Noel will tell you a little bit more about once we find the deal, acquire it. The next step is to really um, solidify the deal through our property management and business plan.
All right. So we'll have says that a good business plan is really key. And so from the beginning to the end, the acquisition strategy, the exit strategy, and also your 30, 60, 90-day plan on how you're going to go ahead and make this building operational is totally key here. And I want to just point out that the most, again, outside of underwriting, the second most important thing that I think it is, and again, I am biased again, is operating. Do you know how to operate? And so you have to have a feel for operating. And what that means is not only looking at the analytics of all the spreadsheets, but you have to have game time reps. You have to have the feel for the game of knowing, hey, this isn't right, this is off. Being able to look at something in a metric, like, or inside of a building, like, no, that's not right. And that's only done with repetition and time and years. And collectively we have over 15 years experience in doing this, and an exceptional track record as well. So that's why I just want to make sure it's key about the operational plan, knowing when leases are up, the lease turnover plans, what should we make the market rents, what type of value adds we should bring in there. Should we be bringing quartz countertops in there? Does that quartz countertop actually benefit us or does it not? So these are things that we always have in operational plans to just make sure we're just really optimizing returns. Next slide. So the proposition right here. So Invictus Elite Capital provides a dual approach strategy, really catering both to moderate and high risk investors, seeking long-term growth and significant appreciation. Our commitment to strategic, data-driven decisions ensures that we maximize value and deliver on projected returns. Now you read that, you're like, what the hell does that mean? All right, so what that really means, in layman terms, is that guess what? I'm always bringing it back down to you. I'm going to go back to real estate stability versus market roller coaster. So we don't ride waves, we build the shoreline. If that makes sense. Stock market in 2020, where was it at? Does anybody know? I'll tell you because I was in there. Down 30% in a month. Investors panicked. How about mutual funds? Tied to that same volatility. With us, every dollar you invested was working safely behind the scenes. While Wall Street took hits, we provided steady, reliable cash flow. Why, might you ask? Real estate is backed by hard assets, not speculation, properties that generate cash, and market-proof strategies. So, I just wanted to put that in the key. And another thing to think about is that if you had a dollar, let's put it, say $1. If you had $1, and I'll go back to 2017. If you had $1 in 2017, with us, you would have been earning by now $1.89. And the stocks would have been really $1.15. Mutual funds, probably a little bit less. Bottom line is, with us, that dollar turns confidently. With others, it's wobbled, and really based on, guess what? Who's the president-elect? How many times is everybody waiting, to see where the market is going up and down? So I just want to make sure you understand what that investor proposition means. Next slide. Got it. So I just want to leave this right here because this was really a great moment, in LA. Had a great time there. The vibe, the synergy was awesome. And I just want to, if I can think of, one phrase for this, I would consider it, we're changing the game. Real estate isn't just an investment, it's a legacy. With us, you just don't grow your money, you dominate the playing field. It's safe, it's lucrative, and exclusive because we only partner with those who understand our value. And excuse the crayon, I just realized I had it in my hand. So we're not just talking or just asking about, asking you for an investment. We're inviting you to partner with us in creating lasting wealth. Together, we'll seize opportunities, transform properties, and build an unstoppable portfolio that delivers exceptional returns year after year. This isn't about money. It's about joining a winning team, being part of something bigger, and creating a legacy that outlasts market trends and economic shifts. The window, opportunity is open, but it won't stay open forever. We got great deals that Art just, pointed out, and like great partnerships, they don't wait. So let's lock arms and make your capital work harder, smarter, and better than ever before. I know you're ready. Come on, let's do this together. And this is our contact information right here. Just go ahead and shoot your emails, and there is the phone number. That is a direct line that you will get. Not no one, not a VA. That's going to be a direct line. You get to talk to a human.
Does anyone have any questions, or who's joining the team? So just FYI, this session is kind of like the family and friends session. This fund will be a closed fund. You will not be able to get in at a certain point. That's just one of the rules of the way that we're going to structure this fund. So it's not kind of like a thing where you just, I'll get in when I want to get in. This is not that type of party. So there's limited spots, and I just posted the proper email address. hello@invictuselitecapital.com. Yes, Odada. Odada said I'm in faster, farther together. Further, farther, faster, baby. You know what movie that's from? I think that's what it is. Further, faster, smarter, something like that.
Forrest
Captain
Gump.
Captain Marvel, and I'm saying it wrong. I'm butchering it.
Yeah.
I'm butchering it. That's what I'm talking about. Anybody else have any questions? This is the time to ask your questions. There is no dumb question.
I have a question.
Yes, ma'am.
For the fund, are you raising deal to deal, or is it basically you're pooling overall capital and then you're deploying it for various different deals? Like, what's the actual structure that you're planning to raise and also to deploy capital?
So it's different. It's not like a syndication where it's from deal to deal. We are raising the capital of 15 million. Once we get to the 15 million, it's closed. And then we're going to immediately deploy the capital. So we'll have a lot more buying power, a lot more leverage when we do it that way, so that we can return better returns to our investors. Because we'll be able to move more quickly and we'll have just more leverage over the deals themselves.
I'm gonna be at the dinner tomorrow, so I'll chat more. I just have the girls in the back, so it's a lot of noise. I don't wanna.
Yeah, you already know I know. Anybody else have any questions? Who else is
None,
joining?
no questions. Yeah, I just want to add, I'm super excited about this. You know, getting into apartments does not have to be a major barrier when we do it together. And no matter your financial level, just use examples of Grant Cardone or Don Peebles, or even some of the people playing at the very, very highest levels of the game. When it comes to purchasing apartments, they're doing it with teams, and that's what we're putting together here. And I'm super excited about it. I'll reiterate again. Um, Not only will we be investing and making money, but we'll be having fun. No pun intended, with the fun and the fun that we'll have with BTS and extended family, um, and doing it together.
Amen. All right, if there are any other questions, great. If you can think of anything, please reach out to me. Y'all, most of y'all know how to find me. hello@invictuselitecapital.com, or you can just text me at this number that goes directly to me. I would love to partner with you. We all would love to partner with you. Like Noel said, we changing the game. Things are going to be just, it's different over here. Y'all already know. So I'm excited to be partnering with you, Odada. You're my girl. I appreciate it. And all right, everyone, good night.